Hello everybody. Welcome back to Red, White and Revenue. Today's topic is critical for small businesses, investors and everyone watching economy. We are talking about the latest moves between United States and China about tariffs, what I'm calling a trade war 2.0. We'll unpack what's happening and why does it matter. And most importantly, how it could shape up American business and investment strategy. So let's dive in. First, some background. Under the administration of Donald J. Trump, we saw historically high tariffs on Chinese imports. We are talking about rates reaching over 100% in some cases. In early 2025, United States declared national emergency over trade deficit that invoked reciprocal tariffs, for example, a baseline of 10% on almost all imports and much higher tiers for some specific countries such as China. By May, the United States and China reached 90 days period of agreement where they lowered their temporary lowering of tariffs. And now we are looking at potentially phase 2 of negotiations that can probably create another agreement that's going to lower tariffs as well. So just heads up, we are still in a fluid environment. Some reports say the deal is done. Others say Chinese side denies the concrete talks. So we don't know what's really going to happen, but we will know next week actually, because Trump actually flew over to Asia right now. So they will have talks I believe in Thursday. So what exactly China and United States negotiating about? Here's the key areas that you need to watch. Tariff rates and durations. That's number one. Will current rates be rolled back permanently or suspended temporarily? For example, the 90 days pause on window, but not necessarily a long-term solution. Number two, supply chain access and market opening. The US wants China to open markets, remove unfair subsidies and trade practices. China wants reduced tariffs, import access, preservation of export base. Number three, critical sector like tech, agriculture, rare earth. Those are high stakes. China controls a lot of rare earth exports and the US wants access to it. Meanwhile, US manufacturers depends on China components. Number four, escalation triggers. Several reports indicates if deal is not placed by certain date, for example, November, tariffs could revert and escalate. Number five, uncertainty and leverage. Both sides are using negotiations and public statements as leverage. For instance, China denied any active talks even while US officials are signaling progress. So what does this mean in practice? Here are three possible scenarios. Number A scenario. A lasting deal is reached. Tariffs come down, business costs fall, supply chain shifts. Scenario B. A temporary truce is extended but not resolved. Some relief but uncertainty remains. Scenario C. No deal, tariffs escalates, cost spikes, supply chains scramble, global firm adjust fast. So now let's zoom into small businesses. You might be listening right now. How will this outcome above affect you? Supply chain cost relief if tariffs go down. Business improving, parts from China could see a cost saving, may be improved by margins and competitive pricing. Competitive pressure. On the flip side, tariffs are lifted. Cheaper Chinese import could flood the market with pressure of United States small business and manufacturers unless they differentiate. Export opportunities. If China opens up, some US small businesses might gain export channels, but only if they scale up, adopt, and compete globally. And strategic risk and timing. The unknown is timing. If you are late, you might have competitive or too high risk cost supply contracts. Or if tariffs comes back, you might be exposed. For example, imagine a small Ohio electronics assembly that source PCBs from China. If tariffs drop, their cost boards drop like by 5 to 10%. Their margins improves. But if markets fails with cheaper assembly boards from China, they must pivot. What should a small business do? Here are some 3 action items. Number 1, audit your supply chain. Map Chinese components or suppliers. Estimate cost impact if tariffs drop by 5 to 10%. Number 2, create scenario planning. Scenario if tariffs remains, scenario if they ease, scenario if they escalate. Number 3, talk to your customers. Let them know you are monitoring risk benefits, so may pass savings or losses and migrate risk to them. Okay, investors, you're not forgotten, so this is the big one for you. So we're going to talk about 2 different sides of this coin. Number 1, the industries that are likely to benefit is firms that rely on China for components and global supplies. And usually when they ease tariffs, logistics and shipping companies, firms might see higher volumes, so they can benefit from this. And industries that's going to be at risk is usually companies that manufacture more in the United States, and now since components going to come from China more, they're going to see more competition. So that's going to hurt them a lot. And macro picture in this whole scenario is lower tariffs might boost global trade volumes, which can help industry shipping and global logistics, but could also reduce inflation with impacts of interest rates and valuations. So we're going to talk about timing and policy risks. Don't chase headlines alone. Big moves often happens weeks, months after agreements. Here's a quick table of winners versus losers. Winners sectors and losing sectors. US manufacturers importing from China. US niche producers protected by high tariffs, global logistics shipping firms. Domestic firms with tariff-protected business models. Firms reliant on high-cost US supply base. Actionable for investors. Review portfolio companies with China exposure. What's their input cost? What's their competitor risk? What's the upcoming earnings for mentions of tariffs, supply chain exposure, and margin stress? If you expect tariffs to ease, look at the companies positioned to benefit from cost drop, supply chain simplifications. Look at some real-world examples to make this tangible. Case study 1, a small US furniture manufacturer that sources upholstery fabrics from China. When tariff spikes, costs increase by 12%. If tariffs ease, they could reduce their cost and maybe hire more staff or invest into automation. Case study 2, US tech components maker forced to shift non-Chinese supplies because of tariffs. If a deal lowers tariffs or China opens up exports, they may rethink their strategy. Also, supply chain diversification is a key. Many companies are splitting sourcing from China to Vietnam, Mexico, or US. They're not 100% exposed to China-US based tension. Small businesses cannot always move fast, but you can start asking questions. For example, which parts are sourced from China? What is the cost change by percentage if tariffs go up? What if tariffs go up again? What does it mean to my business? So now it's time for caution. What can go wrong? False optimism, maybe. A headline, deal reach, doesn't mean full implementation. Many past deals stalled or were reversed. Tariff re-escalation. If China doesn't comply, US could hit new tariffs or restrictions, for example, on rare earth exports. Inflation and cost pass-through. If tariffs drop, that may be a rush to import now, which could disturb logistics and keep freight rates high. Political risk. Trade policy can change fast. In domestic politics, elections or crisis escalation could happen. There's a few signs you should watch out for. Mentions of tariffs pause, extension dates, for example, November 10th or recent talks or whatever. Corporate disclosures or tariff risks or cost of goods rising due to trade policies. Supply chain bottlenecks, which may cause prices increase. So here's your take-home action for both business owners and investors. For business owners, audit your China exposure. Scenario plan, optimize for tariffs staying high, tariffs easing, or tariffs rising. Budget for volatility. Maybe maintain or buffer your supply flexibility. And for investors, review exposure to companies with China supply chain risk. Watch upcoming trade announcements, earnings calls, and tariffs commentary. Consider hedging strategies or adjusting positions towards less exposed companies. So this is it, guys. That wraps up our video diving into trade war 2.0 between US and China tariffs negotiations. So if you like this video, hit the like button below, subscribe to our channel, and we'll see you in the next one.